In this video, we will focus on the long-term sources of finance for businesses. Let's discuss what are the shares. Capital of a company is divided into small units called shares. For example, if the company has an equity capital of £10,000, it can be split into 1,000 shares worth £10 each. A person who owns a share is called a shareholder. So each share represents a part of the company capital. Each shareholder is an owner of a small or large part of a company. In the past, companies used to issue certificates of stock ownership, something like this. You probably saw them in some old movies when someone finds a pack of very old shares somewhere in their loft, purchased by their grand-granddad, and the shares have been forgotten for many decades, and now they happen to be worth millions. Nowadays, all certificates of stock ownership is electronic. You won't get a nicely printed piece of paper like this. For example, I personally have more than 100 various companies in my investment portfolio, more than 100 different types of shares, and not a single piece of paper. All certificates of ownership is now digital. Shares are transferable and can be traded on stock exchange for listed companies if it's listed in a stock exchange, and issue of shares is the main source of the long-term finance for the company. Company can issue two types of shares with different risk-reward ratios: ordinary shares and preferred shares or stock. Ordinary shares, also called common shares or common stock or equity stock, are stocks sold on a public exchange. Each share represents a fraction of ownership in the corporation that issued it and gives its owners the right to one vote at a company shareholders meeting. There are certain advantages and disadvantages of holding ordinary shares. Unlike in the case of preferred shares, the owner of ordinary shares is not guaranteed any dividend. The company may or may not pay it. If the company does pay dividends, ordinary shareholders will only get paid after the company paid what it owed on their bank loans, interest charges, coupon on bonds, and debentures, which will be discussed later, and dividend on preferred shares. Ordinary shareholders will be the last in the queue for their dividends. If there will be any money left, and if the board decides that the company should pay a dividend to ordinary shareholders, they will receive their payment. Apart from this, ordinary shareholders are also last in the queue in case of a liquidation of the company. They will only get their capital back after all other creditors, debenture or bond holders, and preferred shareholders have been paid. That is why they are considered to be riskier than preferred shares. However, ordinary shareholders might get a dividend at a higher rate, and growth of the capital can also be higher, because share price in the stock market does go up if the company is profitable and successful. Ordinary shares are very liquid, it's easy to buy and sell them in the stock market, and the vast majority of shares sold in all British, American, and other international stock exchanges are ordinary shares. A corporation may also issue preferred shares. They are kind of a combination or a hybrid of a common stock and the bond. Bonds are more secure financial instruments with a guaranteed return, while common stock is riskier but potentially more profitable. Preference shares do offer some preferential rights. First of all, their owners are guaranteed a certain dividend payment at a set fixed rate. A company has to pay certain dividend that was promised. It cannot cancel it. They also have a higher claim to asset distribution. For example, in case of liquidation, they will be high in the queue of creditors and will get their capital back before ordinary shareholders. Ordinary shareholders are always the last to get their money back if the company goes bankrupt and risk losing all their capital. That's why preferred shares carry less risk. However, preferred shares have limited voting rights. The price of preferred shares may rise or fall, but it's not as volatile as the common stock price, and investors in preferred shares are usually motivated primarily by the steady income from dividends. The details of each preferred stock depends on the specific issue and specific company. So if we summarize the differences between preference shares and ordinary shares or equity or common stock, we'll see that it's not compulsory to issue preference shares, while the company does need to issue ordinary share capital. Dividends are paid to preference shareholders at a fixed rate, while ordinary shareholders may or may not receive the dividend only after everyone else have been paid. The capital is refunded to preference shareholders before it's returned to equity shares, while ordinary shareholders only get their capital back in a case of liquidation only after other creditors were satisfied and preference share capital have been returned. Preference shares, however, do not carry any voting rights, while ordinary shareholders can vote in shareholders' meetings. These are the main differences between preference and ordinary shares. Next very important type of long-term financing for the company is a debenture. It's a type of a debt instrument which is not secured by any collateral and only backed by creditworthiness and reputation of the issuer. When a company wants to borrow a large amount of capital for the fixed term, it can borrow it from the general public by issuing this financial instrument, debentures. It's a written acknowledgement of the money borrowed and the terms of conditions of how and when it will be repaid. Please pay attention. It's a debt instrument, not equity, not own capital. Debentures are also issued to the general public in the same way as shares, but when a company sells shares, it attracts and increases its own capital. Shareholders become owners of the company. When it sells debentures, it increases its debt. That is why raising finance using these two sources will have totally different effects on financial ratios of the company, its debt and liquidity metrics, etc. You'll study all of this later in your course. And if you decide to specialize in management accounting, you will need to be able to advise on what would be the best source of finance for your business. So the holders of debentures become creditors of the company. They lend its money in return for some pre-agreed return, periodic interest or coupon payments, but they are not entitled to any profit beyond this agreed interest and they have no voting rights. They cannot take part in everyday decisions or company operations. Usually debentures are issued for a long term, more than 10 years. They are redeemable or repaid on a certain fixed predetermined date. Both corporations and governments frequently use debentures to raise capital or funds. Debentures are a great instrument for companies because they carry relatively low interest rates and longer repayment dates compared to other types of loans and debt instruments. Next, another financial instrument, bonds. Bonds are very similar to debentures, and in many countries the terms are interchangeable. The bond is the most common type of debt instrument used by private corporations and by governments. It also serves as a written acknowledgement of debt between the issuer and an investor. An investor loans a sum of money in return for the promise of repayment at a specified maturity date. Usually bonds are sold at a discount to the face value. In other words, when you buy a bond, you pay less than what the company will repay when the bond matures. Usually the investor also receives periodic interest payments called coupon over the duration of the bond's term. In the investing world, bonds are generally considered to be a relatively safe investment. Highly rated corporate or government bonds come with little perceived default risk, but they will pay a very low coupon rate. It's a low risk, low reward form of investment. Financial advisors will usually recommend to keep a certain part of an investor's portfolio in the form of bonds in order to diversify the portfolio and reduce its risk. However, each bond, including those issued by government agencies or municipalities, will carry an individual credit rating. The safest bonds in the world are treasury bills, called T-bills, issued by the American government. They carry very, very low interest, but they are considered to be the safest form of investment. And of course, there exist some junk bonds in the market too, which can pay high interest but carry significantly higher risk. This slide summarizes the main differences between bonds and debentures. In fact, they are rather subtle. In a sense, the debenture is the most common variety of bonds. Bonds can be secured by company assets, while debentures are usually unsecured loans. Physical assets or collateral do not back debentures. They are only backed by the reputation of the issuer and its credit rating. However, the bond is also considered as creditworthy only as the company that has issued it. Bonds are generally issued by government agencies, large financial institutions, and corporations, while debentures can also be issued by smaller companies. Debentures generally have a more specific purpose than other bonds. While both are issued to raise capital, debentures typically are used to raise capital to meet the expenses of an upcoming project or to pay for some planned expansion. Debentures are sometimes called revenue bonds because the issuer expects to repay the loan from the proceeds of this business project which they help to finance. An important difference is that bondholders will have a priority in repayment at time of liquidation. That's why it's a safer form of assets. However, bonds usually carry lower interest compared to debentures. Good for companies, but not so good for investors, depending on how you look at this debt instrument, from which angle. These are the main differences. As I said, they are not significant. Both are the main type of debt instrument. Next, an important source of the long-term finance for the company is its retained earnings. It's a portion of profit which is not distributed among shareholders, but is retained and used in the business. It will always appear in the financial statements. Any company can set aside part of its profits to meet future requirements for the long-term capital, for future investment, business expansion, and so on. A company can keep its retained earnings, retained profit, in various accounts, which are often called reserves. And as accountants, you will have to deal with these accounts in financial statements on an everyday basis. Finally, a very simple and easier to understand source of the long-term finance for the company is the term loan. Term loan is a monetary loan which is repaid in regular payments over a set period of time. Some banks and other financial institutions have created special business loan programs, specifically aimed to help companies to raise necessary finance, for small startups, to cover operating expenditures, and so on. They frequently last between 1 and 10 years, but can last longer for up to 30 years. They can carry fixed or floating interest rates. A small business which has a bank account will usually start inquiring about the possibility to get such loans from their own bank before attempting other sources. Also, if you're a business owner, it might be wise to compare alternative offers from competing lenders too, because you might get a better deal. However, in any case, regardless of where you apply, you might be asked to provide a business plan to support your loan application. Be prepared for this in case if you hope to start your own business after graduation or work for a small startup as their accountant. You are likely to be involved in this task in preparation of the business plan. So these are the main sources of short-term and long-term finance. Companies can raise funds from a variety of sources, and it's an important task for a financial manager to help the company to develop its financing mix. In other words, a combination of different sources of short-term and long-term finance, a combination of equity capital and debt. And as an accountant, especially if you work as a management accountant, you are very likely to be involved in these sort of decisions.